You bought a share. A few weeks later, it dips. The headlines turn gloomy, and your finger starts hovering over the sell button. We have all been there. But here is a strange question. What if the single best thing you could do for your money was, well, nothing at all? Today, we are talking about coffee can investing, the buy and forget strategy. By the end of this video, you will understand what it is, why doing less can quietly beat doing more, and how to use it on the ASX without fooling yourself.
Before we do though, quick disclaimer. Nothing in this video is financial advice. I'm not a licensed advisor. This is purely educational. Do your own research. Talk to a professional if you need to. All right, let's go.
Here is the uncomfortable truth. For most beginners, the biggest threat to their returns is not a market crash. It is themselves. The urge to tinker, to buy, to sell, to react to every headline quietly eats away at returns. And study after study finds the same thing. The investors who trade the most tend to earn the least. Let me show you the numbers in a moment. So what actually is coffee can investing? In one line, you buy a few quality businesses, you seal them away for 10 years or more, and then you do nothing. No trading, no tinkering, you just let them sit. The idea comes from a fund manager named Robert Kirby back in the 1980s. He told a story about a client whose late husband had quietly copied Kirby's buy recommendations but ignored every single sell. He just put the shares away and forgot about them. Years later, that do-nothing portfolio was worth a small fortune. The name comes from the old days when people kept their valuables in a coffee can under the mattress. The method has 4 simple steps. 1. Pick quality businesses you would happily own for a decade. 2. Buy a spread of them so 1 or 2 can carry the rest. 3. Seal the can. No trading, no tinkering. And 4. Open it in 10 years or more and let time do the work. Now, does doing less really beat doing more? One famous study followed more than 66,000 investors. The market itself returned about 17.9%. That gap, roughly 6.5% every single year, is the price of restlessness. Same market, very different outcome, just from trading too much. Let us make this real with an Australian example. CSL, the blood plasma and biotech giant, floated back in 1994. Adjusted for a later share split, those first shares cost under $1 each. For years, CSL was the textbook coffee can stock. A holder who simply never sold turned every $1,000 into well over $100,000. But here is the honest part. In 2025 and 2026, CSL stumbled badly. Profit downgrades and a share price still around 2/3 below its peak. Even the very best compounders go through brutal years. The coffee can only works if you can hold through them. Which brings us to the most common mistake. Selling your winners too early just to lock in a small gain. It feels smart. It feels safe. But it is usually how people cut their flowers and keep their weeds. The whole point of the coffee can is to stop you doing exactly that. Now, I have to be honest with you, because this is where a lot of videos go quiet. The coffee can holds your losers too. For every CSL, there are companies that quietly went to zero. Names like ABC Learning and Dick Smith. So why does the math still work? Because a loser can only ever fall 100%, but a winner can rise 1,000% or more. A handful of big winners can outweigh many small losers, but only if you own enough quality businesses to give yourself those winners in the first place. There is one more reason this strategy suits Australia so well. Franking credits, When you never sell, fully franked dividends can be reinvested and compound quietly inside your coffee can year after year. Take Commonwealth Bank's 1991 float. A stake of just over $2,000, with dividends reinvested, grew to around $138,000 by 2020. Fully franked, never sold. And low tax rate investors, like many retirees, even get the excess credits refunded. So if you take just one thing from today, let it be this. The hardest skill in investing is not picking winners. It is leaving good things alone. Buy quality, diversify, and then do nothing for a decade. If this helped, please subscribing. Keeps the channel going. Thanks for watching.